everyone. So let's continue talking about our topic 4, which is labor market and financial markets. And as we said in class, uh, the idea behind this topic is to relate the real side to the monetary side. And we will expand on this idea later towards the second half of the semester. So we already done with the labor market, and we had started the financial markets. We said that any market has a demand, has a supply, and the interaction between both will give us the price. So when we talk about the financial market, we have people who demand funds or demand money or demand financial capital. And as I mentioned in class, financial capital stands for money in our course, and don't mix it up with stocks and bonds, um, because the students in the business school would take financial market definition as the market for the trading of stocks and bonds. But for our course, we will be talking about money. Um, and also, as I said in class, sometimes I say money, sometimes I say financial capital, and sometimes I just say funds. So they are all the same meaning. So the interaction between those who demand funds, the ones that demand funds are the borrowers, and those who supply funds are the savers. Their interaction will determine a certain price, where the price in the financial market is the interest rate. Okay? And we mentioned in class that usury laws basically means that they set an upper limit for the interest rate charged by lenders. Okay, you can actually apply it in any market, like the real estate market, as we have an article in this topic about the real estate market in Manhattan, and there they set a maximum price on the rent. Okay, because the rent can go like with limited amount of units, the price or rental price or the rental rate can go way up high, so they have to set an upper limit for the rent. But here, let's say if I'm talking about lending money, then the lender um, has to have a certain limit, because otherwise, as again I mentioned in class, they can go all the way up to 100%. So why not? So the usury law basically say that they have to set an upper limit for lenders, and this is just an example. So in Texas, they have an upper limit of 18%. So a bank offering a loan to those borrowers or the demanders of funds, they cannot pay it back more than 18%, or the cost of borrowing is no more than 18%. Otherwise, the lender would have to pay a certain penalty, for example, 3 times the amount of the excessive interest rate charged. So if they charge 20%, which is above the 18%, then they would have to pay an interest rate which is 3 times that percentage, which could be like, can actually exceed 100%. And also they would have to pay attorney fees. Any market has the price, has the quantity supplied and demand, has the supply curve positively sloped, the demand curve negatively sloped, and the idea is always the same. The higher the price, the higher the supply. Here, the higher the price, the higher the number of people willing to supply their funds or savers. And in any market, the higher the price, the lower is the demand. So the higher the price here, or the higher interest rate, implies that we have less and less people demanding funds or borrowers. So anytime I'm talking above an equilibrium in any market, I'm talking about a surplus where saving or savers exceed, or the number of savers exceed the number of borrowers. So in this situation, we would have excess supply. And then any point below the equilibrium, we have the number of borrowers exceeds the number of lenders, because at a relatively low interest rate, when I say relatively low, I'm comparing it with an equilibrium. So 13 is less than 15. At this rate, the borrowers are happy because it's below equilibrium, so they would demand more loans, while the savers are not happy about that low or relatively low interest rate, so they would supply less. So we would have excess demand or shortage. So the equilibrium is going to happen at a certain rate, okay? And the price ceiling is RC, which would be a certain amount of, or a certain rate, a certain level of interest rate that is set below equilibrium level. And it's basically the maximum interest rate that can be charged, or you can think of it as the maximum price, because interest rate is the price of funds, okay? At this level of price ceiling, it's below equilibrium, as we mentioned in the previous slide. This creates shortage in the market, okay? So we have excess demand or shortage. This is the article I was mentioning. So we have an example of price ceiling, which is the rental rate in Manhattan, rental control, okay? And I wanted to read this article. It's a short article, it's interesting, and the main points that you will get out of this article are basically 3 important points. The number one is that rental control started in New York, or New York City, in 1943. This is the first time they started to apply the rental control, okay? Because they have seen cases where landlords are charging tenants way above equilibrium. When we say equilibrium in real life, we say average or historical average value, okay? And then you will also read about economic and social implications. So when we control rent, how this affects landlords. So they would be discouraged, right, to take care of these units, to maintain these units, right? Because they know that they are not getting rental rate as much as they believe they can. Also, you will get out of this article that we have to make a balance, right? And this balance, as we have started, since we have started this course, is always about demand and supply, okay? So we need to find a way to provide affordable living, right, for those who are demanding housing units, and that is not discouraging landlords, okay? So those are the suppliers, not the funds in this case, but suppliers of rental units. When you read this article, I want you to focus on the supply and demand disruptions, okay? So how rental control disrupts the natural flow of supply and demand. So what you can see, let's say an example here, this is a disruption of the natural flow of supply and demand. Equilibrium is the natural flow of supply and demand. But when a rental control or a price ceiling is set to this interaction between supply and demand, right, which is the interference in the market, setting a certain limit, whether it's minimum wage, whether it's rental control, it's the same idea. So we want to know how this is affecting the natural flow of interaction between supply and demand, how this is affecting the quality of housing, because as we said, probably landlords are not maintaining the houses as they should. And also I wanted to notice about the inequitable distribution, because if this policy is supposed to help low income class or lower income individuals, then we have some people who are benefiting of this, which are the middle and the high income class. Okay, so how this is affecting distribution of income. Okay, so there are those proponents of the idea of rental control, and they are basically saying it's essential in areas like Manhattan, because otherwise you will just see those rich or relatively from the high income group who are able to rent these units. Otherwise, rental control is important because it helps allowing diversity in the real estate market in a busy city like Manhattan. All right, so when we talk about demand and supply, we can apply it to anything. It doesn't have to be rental market. It doesn't have to be only financial capital market. It doesn't have to be the labor market, but we can also apply it to other cases. So we can look at supply and demand and think about the government. So as we know, we have a growing government debt in the US, okay? And if you think about interest rate, which is the price of funds, this is the equilibrium point between the supply and demand. And if we think about those who are supplying the funds to the government are the foreign sector, maybe foreign countries. So they are offering their funds maybe through buying government debt. So buying government debt is a way that I should say buying government bonds. Okay, the idea is the same. So buying government bonds is like buying the government debt or lending to the US. So if you assume that the foreign sector, whether those are foreign companies trying to invest in the US Treasury bills or the US long-term bonds, it's like they are supplying funds to the US. Okay, so if we assume that everything is fine, we will reach a certain equilibrium. But what if those investors, when they see that how the US debt is growing, okay, they might not be as enthusiastic about offering their money to the US. They probably would be discouraged. And as we read in the news, there are a reduction in the flow of funds from the foreign sector to the US debt, or the share of the foreign sector in the US debt is diminishing over the last 10 years. So the implication of that is if the suppliers are not enthusiastic about the situation in the US, they will reduce their funds, and this is actually what is happening. So the supply of funds is going to shift towards the left. As the supply shifts toward the left, the interest rate, so the quantity goes from Q0 to Q1, the interest rate goes up. It's just the law of supply, where as the quantity supplied decreases, the interest rate would increase. Okay, so the lower is the quantity of financial investment. So the next part is talking about the connection between money and prices. So we know that inflation rate, so this is something that I'm recalling here. Okay, so wait. Don't ask me what happened. Okay, so we're recalling that inflation rate is the percentage change in the average price level, the CPI or any kind of index, deflator or anything. And this is the price that is required to buy a good or service, okay? And the price is defined in terms of money, okay? So we will talk about money, the supply of money, and how this money is controlled. And as we know, it's controlled by the central bank or the Fed in the US. So the definition of money, it's an asset. So it's the stock of assets that can be readily used for transactions. So it's an asset that has certain functions. It's a medium of exchange. So we all accept it as this piece of paper is used in our transactions, in our exchanges. And we all agree that we accept this piece of paper. Okay? It's a store of value because it transfers purchasing power from the present to the future. I can store it, I can save it. Okay? And it's a unit of account. Okay? Because the common unit that everyone measures is the price and value. So it's a unit of account. It has a certain value, which is whether it's in dollars, a certain amount of dollars, and so on. We have basically two types of money. We have the fiat money, like the paper currency we use. It's called the fiat money. And we have a commodity money, which was used back in the past, which is like gold and silver and important natural resources. So when we talk about the money supply, which is the quantity of money available in the economy, and I'm always going to abbreviate it as MS, which is the money supply. Monetary policy is the control over this money supply. Okay, so when we were watching the video of Zimbabwe and we were talking about hyperinflation and printing money is money supply, an increase in the money supply. Who is doing this is the Fed, who is controlling the monetary policy. So central banks, we call it like central banks in most of the countries. In the US, we call it the Fed or the Federal Reserve, which is located in Washington, D.C. So when you look at the money supply has three main definitions. So one is the simple definition. I'm sorry, not this one. One is the simple definition and one is the broad definition. Currency, you already know what is currency, okay, which is the money in circulation in the economy, which is the cash in our pockets, okay? And then we have, in addition to this currency, we have the demand deposits, which is like our checking accounts, traveler's check, and other checkable deposits. So anything that we actually own, debit cards, okay? And the broader definition includes the small time deposits. So these are deposits for a short period of time, or the saving deposits, okay? The money market mutual funds and the money market deposit accounts. Okay, so all of these are in the broad definition of money. When you click on this link, you will see the latest amount of the C, the M1, and the M2. Okay? The quantity theory of money is important because it will provide some link between inflation rate and the growth of money supply. Okay, so it's like inflation versus money supply. As the money supply increases, prices would go up. And one way that money supply increases is printing money, right? Printing money increases the money supply. All right, let me stop here and I'll record the rest for you.